Hi, good evening, Shavi. Can you confirm my audibility? Am I audible enough? All right, thanks for confirming, Shavi. I'll be sharing my screen. You need to confirm the visibility of the screen. Can you see the screen? All right, thanks for confirming. So once again, welcome to the day 2 of revision session for strategic business reporting for September 2024. So today I've given a small agenda as to what we are expecting to do within today's session, right? So first, we will be looking at the exam format of SBR. We'll just go into it in a summary. And then we would be looking at the new question 1 format, the format that changed from September 2023 onwards. All right. And the past exams that you'll have to experience these question format are March, June, which was a recent one, and September, December. All right. So March, June 2024 and September, December 2023. All right. So when you talk about the question 1 format, I had shared the specimen 1 exam last class or last week rather. So I had shared a question saying that I had held back the information about the change because I wanted to discuss that today. All right. So this is the new format that is applicable throughout. So we'll be looking at what that new format is as well. Okay. And then we'll be looking at one of the new syllabus areas or new standards introduced in SBR, which is specifically being tested from September 2024, which is the upcoming session. So you need to be very particularly clear and thorough about this subject area. All right. And then we would be looking at the technical articles, the recent technical articles that have released for the September 2024 related syllabus area. All right. So we'll be looking at a summary of that technical article as well. And then we would be looking at the core standards that you need to focus on apart from all the standards in general. I mean, as an SBR candidate, you need to be particularly prepared with all the standards in general, but there are certain standards that you need to pay very particular attention to. All right, so we'll be looking at what those standards are. And then finally, we would be discussing the specimen 1. If time permits, we'll be doing the entire paper discussion. Otherwise, we would be specifically looking at the question 1, the updated format, and the question 2. Okay, that's the target for the day. If time permits, we'll be discussing more. All right. Also to mention that past papers is something that you all have to attempt. And I had mentioned in the last class as to what are the different additional readings that you all need to do apart from being prepared with your study text related content. Okay, so there is additional reading that you have to do. I'm sure you would be remembering what we did in the last class. So make sure whatever is required, do read that. Okay, so even past paper practice is very important. You cannot go to the exam without practicing the past papers. Therefore, practice all the past papers. And as you have finished practicing past papers, as you have finished answering, and as you are reviewing the answers for the past papers, make sure you review the examiner reports for the same. Okay. So very recently, the examiner report for March, June 2024 paper has also been released. So when you are attempting that question, make sure you would be looking at that examiner report as well. We'll see if we are able to, we'll discuss that particular, the final examiner report, or maybe the previous one as well in the next class, just to see how we need to align ourselves with the new changing requirement, especially with the question 1 format change. Okay, So that is what we may look at in the next week. And one entire week we will be spending to discuss the pre-mock, right? A very important element before that you all need to practice before you all get into the exam. So we'll be discussing on that as well. Okay. This is the agenda for the day. Is that clear? Any questions so far? Anything to do with the agenda that you think I need to add, I need to remove, or there is something that you want specifically looked at? Anything as such? Now, when we are discussing questions, of course, we'll be touching upon identifying the different standards that are relevant to those questions, right? Apart from that, I mean, we'll be doing a little bit of discussion on those standards as well. But apart from that, anything else that you think that you need specifically to be looked at before you go into the exam? Anything, Shavi? All right, so I think we are good to proceed with the first agenda item. All right, so let me take you through how the syllabus structure, not the syllabus structure, or the exam structure is going to work. All right. All right, Shavi. So those are particular standard areas, consolidation of financial instruments. Let me see how I can, help you out with those particular areas once we are done with the agenda items. And if not, you always can contact me, and we can, I can help you out with a summary, or rather, I can send you on WhatsApp or on any medium where you can review the summary and remember it in case we're not able to look at that within the classroom or within the live classes. All right. Okay, so starting off with the exam format. What is the exam format for SBR? I am sure you should be knowing the answer to this question by now, but let's just, for the purpose of having a clarity about it, let's look at how the exam format is going to look like. Okay. So exam format is going to be a 3 hours and 15 minutes exam, right? So it's a 3 hours and 15-minute exam. In that 15 minutes usually is spent to read and to figure out what are the questions you're going to start with, what are the easy areas. So that's what you usually spend the 15 minutes, but you can actually incorporate that into your plan as well. But usually or technically we plan for 3 hours, which is 180 minutes, right? So that brings us to 1.8 mark per minute that we discussed last week. All right, so we have section A and section B. There are two sections that we have in SBR exam. Okay, if we take section A, there are going to be 2 questions. All right, and first question would be for 30 marks, and second question will be for 20 marks, right? And then section B would have 2 questions. Here, both the questions would carry 25 marks each. Right. Now, that's not all, right? That's not all. There is something called professional marks that you'll be getting. Okay? It's something called professional marks you'll be getting for SBR, which is 4 marks. Okay? It's 4 professional marks you'll be getting in your entire exam. So out of that 4 marks, 2 marks are going to be for second question, and 2 marks are going to be for fourth question. Right? Right. Now the first question is where there has been a new format that has released, right? And this question in particular is going to test you based on that new format. And this question is going to be a question about consolidated financial statements. Okay. Now, this doesn't mean that you have to produce an entire financial statements, but you may have to, adjust or amend or correct the financial statements, right? So there could be errors in the financial statements prepared. So you need to identify what the errors are and you need to correct them, right? So you need to adjust the financial statements provided. Okay. Now, what we think when we talk about consolidated financial statements is we limit it to only consolidated statement of financial position or consolidated a statement of profit or loss and other comprehensive income. And we do not pay attention to consolidated statement of cash flows, right? So we think, that's a very rare occurrence, of course. Mostly we are tested on either of the elements of, SOFP or SPL, but cash flow can also be very much tested. Okay, so that's also a component of consolidated financial statement. How cash flow would work for consolidated financial statements, you should be knowing if you would have had a complete technical understanding of IAS 7. All right, and then second question is going to be a question about ethics. Right now, this question is going to focus on ethics. Right, so here there are going to be certain ethical complications in the question that will be given to you, and as you need to look at the question from the perspective of a professional accountant, and you need to identify what the ethical issues are, what are the threats that would have led to the ethical issues, what are the standards, financial standards that are being impacted, right, because of this issue. Right, we discussed this last week, so I'm just taking you through a summary. Right, so what are the financial standards that are being impacted through this ethical violation, and what are the safeguards for the threat? So you need to keep that in your mind. Okay, so safeguard is not something that you'll always be giving, but you need to identify that this is a standard that's being affected, this is the ethical threat that is there, and this is how the financial statements will be affected if this ethical issue is not corrected. Right, and then you have to know the safeguards to give the correcting recommendations. Okay, so that is ethics. Then you would have two questions in section B, which is going to test, any syllabus area, right? Mostly the fourth question is going to be testing more investor focused questions. Now, ethics is having professional mark where you have to make sure you use your professional judgment, skepticism. So they will analyze the answer with the way you've structured your answer and the way you've thought, right, about the answer, the question. And then the fourth question mostly is about investor focused question. Okay, something that is to do with traditional performance measures, right? Or it's to do with the interpretation of financial statements, right? Anything of that sort, which is going to be investor focused. So how professionally you're going to look at the question, how professionally you're going to answer that question is what is going to decide whether you'll be receiving the professional marks for that question or not, right? But remember, consolidated financial statements can test any standards, right, impacting the consolidated financial statements, because all the standards that are impacting single entities will be impacting consolidated financial statements as well. How they are going to impact consolidated financial statements, you need to have all those theory in your mind. You need to have the standard knowledge in your mind, how the standards work, what the standards are, and what are the requirements of the standards, etc. Okay, and ethics also could focus on any standard, any financial standard. Now you can focus on any financial standard. So when you are reading through the questions, you need to identify what are the standards. When you pick on the standards, it will be easier for you to write down the answer, right? So when we look at a specimen question paper, I'll guide you on how to capture, with the keywords, what the standard is and how to recall the standard requirements. Okay, so you need to be thorough with all the standards, and I have given you enough material suggestions last week that you can make use of in order to ensure you become expert in standards. Okay, and section B is going to be a question from any standard or any syllabus area. Okay, so make sure you are prepared with the entire syllabus of your, whatever the syllabus is relevant to you. Okay, for September 2024, right? And we'll be looking at what is an additional area that there is a high chance of being tested in September. Okay, all right. That is the exam format for SBR. Okay. Then we have the new question 1 format of SBR, right? What is the new format for question 1? Okay. Now, before we get into that, I also would like to elaborate on the keywords, right? Key question verbs that you need to know. So mostly the question verbs that you would be expecting for SBR is going to be either discuss, or it's going to be explain, or advice, right? Discuss is where you will be needing to consider and debate in detail, right? So you will have to look at the pros, the cons, you have to bring in the arguments in favor, against that when you are asked to discuss. But when you ask to explain, you need to clarify, bring in clarity to an idea, right? You need to show logically how the concept is developed and what would be the reason for such an issue, right? So that's explained. And advice is where you will have to offer guidance, right? Okay, so that's where you have to end with a recommendation that would allow the decision makers to make good decisions or informed decisions. Okay, those are the 3 main or common exam question verbs that we have experienced in the past, but you need to expect other exam verbs also. So exam verbs has also been explained by ACCA. It's there in the ACCA website. So you can, read about the question verbs before you get into the exam. Okay. Any questions with the format? Or is that clear? Any question, or is that clear? All right. Okay. Now we look at what is the change that we have seen from September 2023. We have seen something called a pre-populated spreadsheet. Something called pre-populated spreadsheet. All right. So this is the new requirement that we have seen from September 2023. Now, how is that going to look like? Okay, I've shared you the specimen 1 exam paper, the question, but let me share the screen and show you how it looks like. Okay. Right, so this is the pre-populated response option. Okay, meaning now they are going to test your Excel skills as well, right? Because now in the real world, in the practical world, any adjustments, any amendments, any financial analysis you'll be doing through Excel, right? You'll be doing through Excel, Google Sheets, but mostly it's Microsoft Excel that's used in workplaces, right? So they have replicated the real or practical scenarios, and they have tried to incorporate that into the exam so that you practice it from this point itself. Okay. The main problem that we have experienced with students from September 2023 is that they have struggled to use the pre-populated response option very well, right? So they've not been able to use the pre-populated response option very well. So in order for you to ensure that you use the pre-populated option properly, you need to practice, right? And to practice, there are not many questions available, right? You have 2 specimen papers. right? You have March, June exam and September, December exam, right? There are going to be 4 papers in total that you will be able to experience and practice this pre-populated exam option. And make sure when you are looking at the pre-populated exam, questions which have pre-populated response, make sure you are going to attempt those and read the exam reports to identify what were the issues with those particular exams, right? So there are 2 examiner reports relevant to this exam format. Okay, so here you need to be very careful about pluses and minuses. Okay, pluses we usually show it as, this, but sometimes what happens in a corporate environment, we are used to showing minuses as this, and this automatically Excel understands that the brackets are minuses. But when you talk about, right, when you talk about brackets in terms of exam response options, you will have to use the minus sign, right? You will have to use the minus sign. Do not use the brackets, right? If you are going to use the brackets, that number is not going to be counted towards your addition or deduction, right? So you need to make sure that you use the proper signs, plus and the minus. Okay, so never use brackets, because using brackets is something where many make a mistake at. And sometimes some students have made mistakes where they have misidentified which one should be plus and which one should be a minus. Okay, right. So that is to do with the new format, right? Or new question format, where that is applicable from September 2023. How many of y'all have experienced this already? How many of y'all have, tried to work along with this new format? Anyone? Please make sure if you're not talking, keep your mics on mute. That would, not break the flow, right? So any of you who have heard about this and, have practiced? Okay. Wait, I mean, y'all should be knowing by now. And yes, y'all will have one more exam to practice, which is pre-mock. So that makes it 5 with pre-populated, right? So we have pre-mock as well. Yeah. All right, so that is to do with the new question 1 format. All right. Then the next item is new syllabus area or standard applicable to be tested, September 2024 onwards. Any guesses? What do you think? Any idea? Because by now you all should have started doing a wider reading. So any idea? Any idea what are the new technical articles that have been released? Any idea what are the new technical articles that have been released? How many of y'all have actually, read any technical articles at all? All right. So the new syllabus area, or is something that is specifically to be tested from September 2024 onwards, is ISSB related. And what is ISSB related standards? It's International Sustainability Standards Board, and they have come up with 2 standards, right? 2 sustainability disclosure standards, right? And those 2 standards are going to be tested from September 2024. So those who are sitting for the September 2024 exam, need to be thorough with these two standards as well. So what are they? IFRS S1 and IFRS S2. Okay. So these are the standards that are very new, that you have not seen in the past papers, past examinations. It's something that you will have to anticipate in your exam. Okay. You need to know the fundamental requirements of the standard. Okay. And to understand the fundamental requirements of the standards, we have two technical articles. We have two technical articles that have been released. Let me show you what the technical articles are. All right. So last week we went through, and I particularly showed you all also this technical article, but let me take you all through it again. Make sure whatever is being, whatever is being taught in the class, so whatever guidance I'm giving you all in the class, make sure you all relook at it after the class is over, right? Just don't limit it only here. You all need to take it into your heads, your hearts, until you all finish the exams. Okay. These are the two technical articles, right? Syllabus area F, right? IFRS Sustainable Disclosure Standards. So here they are saying from September 2024, the SBR exam will test candidates on the IFRS Sustainability Disclosure Standard. Candidates will need to be able to use their knowledge of IFRS S1 and IFRS S2 to assess disclosures of climate-related risks and opportunities. Okay. Then there's climate change and IFRS accounting standards. This helps you to further understand how IFRS S2 can be applicable to different IFRS accounting standards. So I would highly appreciate if you'll read both these standards, but I'll be taking you all through a summary of these two standards, or these two technical articles rather. Okay, I prepared a summary for you all. So I'll be taking you all through the summary for that. Okay, let's look at the summary. All right. Are you all with me? Are you all with me? This very, very important area that we are getting into right now. All right. All right, perfect. So the first technical article that reads IFRS Sustainable Disclosure Standards, that's the article title. Now this, as we clearly saw there, this says from September 2024, the SBI exam will include questions on these standards. Okay. IFRS S1 is general requirements of sustainable disclosures, and IFRS S2 is climate-related disclosures. Okay, IFRS S2 is climate-related disclosures. We'll be looking at what the difference of those two are as well. Okay, just to give you a background, why did IFRS come up with ISSB as a new board that was formed in 2022? It was because we've been hearing a lot about sustainability. There is a lot of buzz around climate changes. We've been experiencing climate changes and all of that, right? So to ensure that finance profession takes the impact of sustainability issues into consideration when the financial statements are prepared, right? So that's the purpose why ISSB was formed. Okay, and they collaborated with all the other standard setting boards that are already in existence, like GRI, then you have ESG, right? So they collaborated with them, and they're still working in collaboration, and they've come up with two standards so far, and there are more standards that are going to be released. Okay, so in 2023, the ISSB issued IFRS S1 and S2. So it was in 2023 that it was released. Therefore, you are being tested in 2024. Okay. Now there are two standards, IFRS accounting standards that are released in 2024, which we are anticipating that ACCA syllabus will incorporate in 2025, right? IFRS 18 and 19. Okay. So the purpose was to create global sustainable standards. Now, looking at in detail, the IFRS S1 standard, the general requirements of sustainable disclosures, right? So this standard mainly covers governance, strategy, risk management, and metrics or targets related to sustainability, right? How are we going to govern, or how are the standards, or how are the sustainability related issues are going to be governed, right? Governance, we understand, we have been hearing about this term governance very often. So it is the governance processes that that's being used to monitor and manage sustainability related risks and opportunities, right? That's what governance aspect looks into. Then the strategy aspects looks into the approach to manage sustainability related risks and opportunities. How are we going to manage the risks and opportunities that that come as a result of sustainability related issues, right? Or sustainability related practices, right? Then risk management is the process that is used to identify, assess, and monitor what the risks and opportunities are arising as a result of sustainability, right? And finally, metrics and targets, meaning how is the entity going to report on the performance, right, in relation to sustainability related risks and opportunities. Okay, so how are they going to measure this? That's what is going to be covered under governance, strategy, risk management, and metrics or targets. Okay. Then you need to ensure that you use IFRS S1 for general disclosures. Now, this you use for general disclosures, right? But IFRS S2 is specifically for climate-related risks, right? Now, sustainability related issues could be non-climate risks also, non-climate related risks as well, right? That could pose a sustainability related issue, right? But IFRS S2 is specifically designed for climate related risks, right? And it allows emission of commercially sensitive information, but not publicly available or risk related data, right? If it is anything commercially sensitive, you can omit that, but not what is publicly available or risk related data. Okay. Then, if we look at the sustainability standards, ISSB, they follow the same conceptual principles, right? They have the same qualitative characteristics, the fundamental, the enhancing, the fundamental being faithful, representation, and relevance. And then you have the enhancing, you have verifiability, comparability, understandability, right? And there is one more, I'm not able to recall it right now. So there are fundamental and enhancing, right? So we have verifiability, comparability, understanding, and timeliness. Yeah, right. So we have timeliness. So those are the 4 enhancing characteristics or enhancing qualitative characteristics, and that is going to remain as it is in ISSB related standards as well. Okay, so most of the fundamental requirements or most of the foundational requirements of IASB are applicable in ISSB also. Okay. Then IFRS S2, climate related disclosures, right? So this focuses on climate related risks and opportunities, right? So this could either be physical risks or it could be transitional risks, right? It could either be physical risks or it could be transitional risks. Okay, so physical risk usually results from direct weather related events, right? You have floods, so damage due to floods, damage due to droughts, tsunami, earthquake, all those are direct weather related risks, so physical risks, right? Physical harm. So, when you talk about the rising temperatures right now, so that is going to lead to rising sea levels. When the sea levels are rising, the biodiversity is going to be lost, right? So there's going to be a lot of issues. Now, even if you talk about certain, islands that they are at a risk of going down below the sea level, right? Because the sea level is constantly at a rise. Yeah. Then transition risk is resulting from when you are transitioning from a high carbon footprint related organization to a low carbon economy, right? Because all the economies have the target, right? The carbon footprint related, right? Controlling emission related targets, right? So when you're transitioning from a carbon heavy economy to lower carbon economy, what are the risks that are there? Within that is known as the transition risks. Okay, so when you talk about IFRS 2, it requires disclosures on governance, risk management, strategy, metrics, targets, and greenhouse gas emissions, right? Greenhouse gas emissions is something that IFRS 2 is going to be dealing with. Okay, so risks are physical, transitional, physical flood and droughts, transitional regulation and market shifts. Metrics, disclosure of GHG or greenhouse gas emissions, which is categorized into scope 1, scope 2, and scope 3 emissions, right? So scope 1 emission is the direct greenhouse gas emissions that is occurring due to the sources that the entity is owning or controlling, right? Meaning that emission is under the control of the entity. So if they want, they can stop that. That's scope 1. Then there's scope 2, which is indirect greenhouse gas emissions, right? From the generation of purchased or acquired, right? So any electricity, steam, heating, or cooling that you consume, right? You use AC, you use fan, you use different machines, right? With coal power, steam power to manufacture things. But coal power, steam power is not as popular now, but it's mostly electricity that you use, right? Cooling system, again, air conditions, the different cooling mechanisms, you have like fans. So whatever the greenhouse gas emissions that result as a generation of those, I mean, you are the one using it, right? Though you cannot control it, you cannot own, or you cannot control how it works, how electricity works, but you are the one using it. That becomes scope 2. That is scope 1, directly controllable, which you, if you want, you can eliminate. Scope 2, indirect, again, you are the one purchasing it, but you can't control, but you definitely can not use that, right? And scope 3 is indirect greenhouse gas emissions, which is not included in scope 2, and that whatever happens within the value chain of an entity, right? So value chain of an entity includes, right, the entire process, right from supplier to the end customer, right? So that entire process, whatever the greenhouse gas emissions happen within that process is your scope 3. Okay, targets, information on climate related targets, including the use of carbon credits, right? There's something called carbon credits. Okay, now when you talk about greenhouse gas emissions, you can give that in numbers, CO2e. That's the metric ton, right? What's a metric ton of greenhouse gas emissions that you've had? So that's how you report it, right? But when I talk about carbon credits, right? So carbon credits is something that you can use, right? So it is a unit that you can use, which is issued by a carbon. I mean, there's an institute or there's a program that is a carbon crediting program, right? And they are the ones issuing carbon credit, which is kind of a document or a source which will be used to prove that you are going to reduce or remove greenhouse gases, right? So you purchase carbon credits in order to ensure that you use those carbon credits towards removing or reducing the greenhouse gases, right? So how an entity is going to use that carbon credits also needs to be disclosed. What are different ways in which you are going to use as an entity the carbon credits, that also you need to disclose, right? And carbon credits are not free of charge. They come at a price. So what's the price, right? What's the impact of this price? That also is something that you need to disclose. Okay. Right. A climate related question, yes, are for us, but not IFRS S1, S2. Those are new standards which were not in existence in 2023. So these are the standards, IFRS S1 and S2, which is being tested for the very first time. All right. So that is the first, the first technical article. How is the interconnected? Shared principles of relevance, faithful representation, comparability, verifiability, timeless, and understandability. Materiality and error correction principles also align with IFRS accounting standards. So anything that's material, how materiality is defined, anything that you misstate, omit, or obscure is going to impact decision making, right? And error correction you have to do retrospectively, as if the error had never happened. So that, again, those principles are aligning with the IFRS accounting standards. Okay, that's how they are interconnected. Is that clear? That's a summary of the first technical article. Any questions so far? Any questions? Yes, Afras, could be, but there would have been no reference to the standards S1 or S2, right? So here there is reference to a standard. The standard is being tested for the first time. Okay, so that's what the technical article means as well. All right. Okay. Do we have any questions? Any clarification that you'll need? What you'll need to remember is the main impact. IFRS S1 is going to be general disclosures. S2, particularly about climate related disclosures, right? So you have, governance process that you have to look into. Then there is strategy, risk management, metrics and targets related to sustainability, right? Then there is something called greenhouse gas emissions, scope 1, scope 2, scope 3, and carbon credits, right? So those are the concepts that are new concepts to you and you need to remember, okay? Right. So let's move on to the second technical article. The second technical article focuses on IFRS S2. How climate changes and IFRS accounting standards are, how IFRS accounting standards are impacted with the climate changes, right? How IFRS S2 is going to impact different IFRS accounting standards. Okay. So we have IFRS Sustainable Disclosure Standard, which is specific to climate related disclosures, and those climate related risks are going to be embedded in multiple different accounting related standards, right? Whatever IASB, right? Whatever IASB related standards, okay, is going to see the embedding of climate related risks, right? So it could be across various standards. But let's say some of the relevant standards, this technical article is focusing on some of the relevant IFRS standards where the climate related risks and the IFRS S2 requirements are embedded in, right? IAS1, presentation of financial statements. Now, this is also an outdated standard to be, right? Because it's being replaced by IFRS 18. I've already mentioned about IFRS 18 in the last session. So make sure you read about this as well. Yeah. So IS1 will become redundant from 2027 onwards. Okay. Requires disclosure of climate-related impacts that are material and affect financial position and performance, right? Including assumptions and judgments, because you are never going to make assumptions and judgments by taking the climate-related impacts into consideration if it is heavily being impacting your economy or your business or your company, right? Then IS2, inventory value adjustments due to obsolescence or cost increases linked to climate change, right? There could be certain inventories. Let's talk about fuel. With all the sustainability related discussions, we've seen that fuel usage is so high that there'll come a time when there'll be no fuel, right? Because it's not something that is going to be available forever, right? So it is a limited resource. So when you talk about that, when the cost increases because of the usage, because of the climate issues, right? Or if there is, let's say there was a flood and your inventory got partially damaged, right? There was a tsunami, your entire, the facility where you had your inventory, meaning your warehouse or your storage facility, completely was washed off. Or there was a fire and half of your goods caught fire. So when those climate related issues take place, the cost increases or obsolescence of inventories, right? Then IAS 12, income taxes, right? Climate-related impacts on estimates of future taxable profits affecting deferred tax assets, right? So future taxable profits also can go down. You have to make certain provisions, so that brings your profit down, right? Environmental provision, so that's something that we've been looking at from a very long time, right? We make environmental provision. That's also connected to sustainability, yeah. Then that's anyway going to, when your profit comes down or profit goes up, that's anyway going to impact the estimation of your deferred tax, right? And future taxable profits as well. Then IAS 16, review of assets, residual value, and useful lives that are affected by climate-related obsolescence, right? Let's talk about a building facility that is partially damaged due to corrosion because it's near an ocean or a sea, right? So due to corrosion, whatever the impact it has on the property, right? So that would be an IAS 16, right? So your useful life, your residual value, everything would go down, right? In IAS 36, climate risks may indicate asset impairments, right? So there could be, when you talk about partial damaged property, so it's an impaired property, right? So that's how it's impacting IAS 36, right? So cash flow projections, what are the continued use cash flow that you're going to expect? That's also going to change, right? Then IAS 37, you are going to have to make a lot of climate-related provisions, climate-related penalties on risk contracts, right? All that comes in with IAS 37 related issue with fire climate, right? Then IFRS 9, financial instruments, impact on credit losses, loan classification, and hedge accounting due to climate-related risks, right? Maybe there could be loans in the future that an organization would be able to take to minimize the impact of climate-related issue that's being caused by their entity. They take a loan, they fix certain things, they restructure and things like that. So that again falls under IFRS 9, which is impacted due to climate-related issues, right? Then IFRS 13, right? The fair value assessment and market assumptions might change due to climate changes. So that is factored into IFRS 13. Okay. So disclosure requirements as per the technical article, it says companies must disclose how climate-related matters affect financial statements and operational performance. That needs to be disclosed clearly. And disclosure should include assumptions, risks, impact on valuations, and any changes in asset values or liabilities due to climate change. So take a note of this word, right? We've been using climate change, whatever disclosure, anything to do with climate change, right? Climate-related matters, okay? And evolving business reporting, the integration of climate change in financial reporting is evolving with increased demand, right? So there are going to be more ISSB related standards, so IFRS S3, S4, S5 in the future. So there are a lot of work in progress that we have with ISSB. So there are a lot of technical agenda that ISSB is going through, okay? But for September 2024, it would be ideal if you are able to dive deeper into IFRS S1, S2, and remember the impact or main components, right? So as we saw here, S1, we have to look at the governance, the strategy, the risk management issue there, right? And then when we talk about the IFRS S2, we have to look at the greenhouse gas emissions, the scope 1, scope 2, scope 3, and carbon credits, right? So things like that. So make sure, these are the two areas, or these are two standards that are going to be tested, maybe heavily, starting September 2024. Clear? Is that clear? So that's the technical article summary. But make sure you all read the technical article in detail as well. Now, this is just a summary that I created while I was reading it through. So make sure you all read it in detail as well, so that you all understand the impact of the new financial sustainability standards, okay? Sustainable disclosure standards. All right. Then comes the core standards to focus. All right. Okay, just throw in some idea. that you think, right, the other core standards that need to be focused? What do you think? And we saw IFRS S1, S2, of course, they are core standards because they are newly, the testing is going to be very freshly started. So IFRS S1 and S2, right? What other standards do you think? Very good, Afraz, IFRS 15. Any standard that are released in last 5 years, again, to be very particular about. Then you have IFRS 9, very good. IFRS 16. Okay. Yeah. Yeah, very true. So you have IFRS 16 because again, lease, what you need to remember are the technical areas of lease, right? Technical areas meaning we are very familiar with the interest when you talk about the payments made in arrears. But payment made in advance is not something that we are very familiar with. So make sure you know those nitty-gritties, and then sale and lease back is something that you need to really focus on, which is again connected to IFRS 15, IFRS 9 within IFRS 16. So make sure you are able to bring that interconnectedness between these three standards in terms of sale and lease back, right? That's one standard. Right? And then you have the consolidated standards, right? But whatever I'm putting maybe in the preference, but you can make sure that you have a thorough, very particular idea about these standards. But make sure you have thorough understanding about other standards as well. Okay, so you have IAS 7, which is cash flow, particularly the cash flow that is to do with consolidation, right? Consolidation impact. Look at that, right? And then we have others, the consolidation standards, right? So we have IFRS 3, which is business combinations, IFRS 10, which is consolidated financial statements. Then we have IAS 28, right? So we have IAS 28, we have IAS 24, which is related party transactions. That's very, very important, right? Related party transactions. So all the consolidation standards. Okay, especially IFRS 3, IFRS 10, right? So these two are very important standards, and particularly you need to be very thorough with how step acquisitions work as well. Okay, right. And then we have what are the standards? We have related party transaction, right? So that is IAS 24, related party transactions, right? That's something that you need to be particular about, right? Then you would have IAS 21, yeah. It's also consolidation. Plus, you should be able to discuss the current issue. Any idea what the current issue is? I took you all through last week. There is a current issue that's happening with IAS 21, right? And there is a technical article on this as well. So make sure you read that, right? You read IAS 21 technical article, okay? There's a technical article that says IAS 21, does it need amending? Okay, and it was a part of it's a part of ongoing projects as well. Okay. Then you have IFRS 13. That's very important. You need to have that idea because somehow or the other IFRS 13 will be tested fair value. I mean, you need to have this idea of how fair value measurement works in different contexts, right? So you need to know IFRS 13 in and out, right? And then there are other IFRS standards, right? Priority to IFRS standards. You have IFRS 8, which is operating segments, right? Then you have other IFRS standards, right? So IFRS 17 is not yet testable. So that, yeah. So IFRS 18, 19, 17 is also still not in the part in the syllabus of ACCA. Therefore, you're safe for the moment. But just know what IFRS 17 is, right? Because you should not, you should not be surprised, the exam when they just touch upon something, right? Because it's a current issue and they expect you to know current issues, right? And IFRS 17 has been in place for quite some time now, right? So although it's not a part of the syllabus, still they expect you to know that as a part of your current issues. So just have, I'm not putting here as a core standard, but IFRS 17, IFRS 18, IFRS 19. Just know what these standards are so that you're not surprised, right, at the exam. And apart from this, income taxes is something, so here deferred tax, impact related consolidation. What are the impact that we're expecting here? Any fair value changes that happen are going to give rise to temporary differences, right? And then IFRS 9 related deferred tax implications. For example, the expected credit loss model, whatever the under provision, over provision is because of IFRS 9 not being applied properly is going to impact your deferred tax, right? Again, temporary differences arising there. Okay, so you need to be in a position where you are able to bring in connection within standards, right? You need to know how standards are interconnected and what are the effects, right? How are the standards affecting different standards, right? Then you need to have an thorough idea about IAS 36, which is impairment. And IAS 38 as a current issue. So you need to know what is the problem with IAS 38, right? IAS 37, again, you need to know the problem, right? Current issue, right? With IAS 37. And apart from that, we have certain projects in progress, right? So IFRS for SMEs, also current issue, right? And then you need to be, when you talk about IFRS 3, I'll just highlight where there are current issues. IFRS 3 has some interesting current issues going. So make sure you all get an understanding about that as well. Okay. And apart from that, you have IAS 7 that is currently, a work in progress, a current issue. And then you have, equity method that is a current issue in IAS 20, as per IAS 28, right? Then you have IFRS 9, the financial instruments with characteristics of equity related current issue going on, right? And then there are current issues with management commentary. Now, this is investor focus. So investor focus is where we can expect management commentary. We can expect additional performance measures, etc. Right? Then you have IFRS 7 power purchase agreements that's being discussed under IFRS 7. That's the current issue there. And then IAS 37 provision is something that they are taking as a current issue for targeted improvements. So you need to know that as well. Okay. So apart from that, as I told you, IAS 21, you need to also know the current, there are two current issues. One is the amendment with the Korean standard setting board that came up with a suggestion and how that did not work, why that did not work. That's one current issue. And there's one more current issue that is the foreign currency related impact in hyperinflationary economies. This also connects to IAS 29, which is not a part of your, which is not part of our syllabus, right? IAS 29 is not a part of our syllabus, but again, it's good to know what IAS 29 is so that you'll be able to discuss the current issue of IAS 21 in more depth, right? So that's that. I mean, these are some of the important standards that you need to have an understanding about in terms of current issues as well and problems. What are the problems that are there, right? And apart from that, you should be able to, or you should be in a position to have a good understanding about challenging standards, right? Challenging standard meaning any problems with the standards, the financial impact and implications, right? Etc. Okay, for example, if you take IAS 16, which is property plant equipment. Now, IAS 16 use historical cost, but historical cost is a very outdated approach, right? Now we use fair value because value changes very often now, right? But standards, there are issues with standards. They are not always updated. Therefore, we need to expect, or we as SBR candidates, you all are expected to have that level of understanding where any standard that involve a lot of judgment should be challenged, or any standard that has outdated approaches should be challenged. For example, IAS 37, IAS 16, etc. All right. IAS 1 also a standard that could have been challenged, but now IFRS 18 replacing IAS 1, which has brought in all the corrections that they saw are necessary. Okay. And apart from that, have some understanding about IAS 2, right? Why IAS 2? Now, this is straightforward approach, right? Inventory valuation versus IFRS 3 inventory valuation at acquisition. So for this purpose, you need to know IAS 2 versus IFRS 3, how you can bring in contrast there. Okay. Apart from that, borrowing cost is something that you can look at. Employee benefits, IAS 19, IAS 33 earnings per share, right? So those are some of the standards that you can look at, right? But these are standards that you need to focus on bringing comparison and contrasting. Okay. We discuss IFRS S1, S2, IFRS 15, IFRS 9, IFRS 16, IAS 7 consolidation impact plus the current issue here. Then we have consolidation standards, IFRS 3, IFRS 10 in particular, and there is IAS 8, which is a current issue again, equity method, right? So apart from that, IAS 24 related party transaction, very important. Section, right? Then IAS 21, the consolidation impact, mainly the current issues, right? Foreign currency related impact in hyperinflationary economies. And, the other issue was whether IAS 21 requires changing or not. So Korean, I'll just add here Korean issue. So just do a little bit of reading here. I don't want to take you all through everything because if I take you all through everything, you all will not be able to enhance your knowledge, right? IFRS 13, fair value measurement. Okay. Yeah, so IFRS 3 is business combinations, right? Business combinations where there is a current issue with business combination. Okay, so what's the current issue that's going on with business combinations is the issues that are to do with goodwill, right? So you have an issue with goodwill, the disclosures and impairment, right? That's the current issue with business combination. All right, and IFRS 13. Yes, so why I've mentioned with IAS 2, the IFRS inventory valuation versus. So let me take this dash out. So IAS 2 inventory valuation versus IFRS 3 inventory valuation at acquisition. There are two inventory valuations that we'll be doing. So IAS 2 requires you to value inventory at the lower of cost or net realizable value. But IFRS 3 requirement for fair value measurement of inventory valuation at acquisition, right? Fair value. At acquisition, right? This is something that you need to be particular about. We'll be discussing these standards in specimen 1 discussion also because the paper or the questions have reference to these standards. So we'll be looking at how we can bring in those contrast here. All right. So apart from this, the rest of the standards, small standards, IAS 16, IAS Again, IS 38, the current issue you need to know in depth, but IS 38 as standard, you need to have a good understanding. So whatever standards are in your syllabus, you need to make sure that you have a good understanding about it. Let me quickly take you all through the standards that we have in the syllabus that are applicable. Right. These are the standards that we have in SBR. So IFRS 2, this you should be able to contrast with IS 19. Okay. Right. IFRS 1, which is first time adoption of international financial reporting standards, the requirements there. Share-based payments, IFRS 2, IFRS 3 business combinations, IFRS 5 non-current assets held for sale and discontinued operations. So this also would mainly, be discussed about. This kind of operation mainly would be discussed about in terms of group accounts consolidation. How is that impacted? Because the subsidiary that's kept for disposal, what's the category there? Just think about it, right? Then IFRS 7, which is financial instruments disclosures, what you need to disclose as a financial instrument standard says. Then IFRS 8, operating segments, IFRS 9, financial instruments, the requirements there. IFRS 10, consolidated financial statements, IFRS 11, joint arrangements, IFRS 12, disclosures of interest in other entities, right? That's also part of SBR. Then fair value measurement, IFRS 13, IFRS 15, revenue from contracts with customers, IFRS 16, leases. All right. Then you have IAS 1, IAS 2, IAS 7, IAS 8. They say here you can see will be superseded in 2027 by IFRS 18. Then IAS 2 is inventory, statement of cash flows, IAS 8, IAS 10, IAS 12, income taxes, IAS 16, IAS 19, again a 2011 version of IAS 19, if you're referring to standard document. IAS 20, government grants. IAS 21, effects of change in foreign exchange rates, right? Again, just look at the issue dates also so that you would know how updated or how outdated the standards are. For example, IAS 7 is 1992, quite old. Income taxes, 1996, quite old, right? This is 1989, my God, IAS 29, right? So that's very old, right? So likewise, just evaluate what the years are. Then you have borrowing cost, IAS 24, related party disclosures. Then you have IAS 27, 28, 29. This is not a part of SBR, right? IAS 29 is not a part of SBR. Financial instruments presentation, IAS 32, that's also part of SBR. Earnings per share, IAS 33, IAS 34, interim financial reporting, right? This is something you need to remember as well. Not very heavily tested, but don't be surprised if it comes. IAS 36 impairment, IAS 37 provisions, IAS 30 intangible assets, IAS 40 investment property. These are all something that you need to have an idea about. And how different it is, the revaluation model, how different it is with IAS 16. Just try to reflect on that, how IAS 40's revaluation model is different from IAS 16 revaluation model. And when it's an IAS 16 that becomes IAS 40, the IAS 40 becomes IAS 16, how the measurement basis change. Just have a look at that, right? Then IAS 41, agriculture. This is also not a very tested standard. Not a widely tested standard rather, but you need to know what these standards are. Okay, so this is all the standards that we have in terms of IASB. Then we have IFRS S1, IFRS S, general disclosures, and climate related. Right. Is everything clear? Are we good? Clear? Any questions? Any questions? All right, so let's quickly go back to our agenda. So we are done with it and we will be moving into specimen 1 discussion. But before we move into specimen 1 discussion, we'll be taking a short break. So it's 7:15 p.m. IST, Indian Standard Time. So We'll take a 15 minutes break and let's connect back at 7:30. All right, guys, shall we start the discussion? Are you with me? All right. So let me open the specimen question. Right. So we'll be reading the question together first and try to see how different standards are being impacted. Okay. All right. Question 1. ACCA has equity interests in several companies, including Greenco. The directors of Chuckle have prepared an incorrect spreadsheet of the consolidated statement of financial position at 1st of April 2026, included in pre-formatted response option and Exhibit 4. All goodwill other than that relating to Greenco has been impaired. I'm sorry, let me share the screen. Correct screen, brother. All right. Can I see the screen? Give me a minute. All right, so let's start looking at the question. Right. Chuckle has equity interests in several companies, including Greenco. The directors of Chuckle have prepared an incorrect spreadsheet. Make a note of this. Meaning there's a spreadsheet that's incorrect that you need to correct. Right. Our consolidated statement of financial position at 1st of April 2026 included in pre-formatted response option. This is what we were discussing about. Pre-formatted response option. And Exhibit 4. All goodwill other than that relating to Greenco has been impaired. The financial year end is 31st of March each year. The following exhibits provide information that is relevant to the question. Initial acquisition of Greenco, meaning initial purchase of 30% of Greenco on 1st of April 2024. Subsequent acquisition of Greenco, which is the subsequent 18% purchase of Greenco and the purchase of share options on 1st of April 2026. Fair value of net assets of Greenco at 1st April 2026. Draft consolidated statement of financial position at 1st April 2026. Okay, so these are the 4 exhibits. Exhibits number 1. Exhibit number 1 is initial acquisition. Right, now before we read now we read the background. That's how you do. First you read the background, then you to write into the requirements. Right, so the requirement A has two sub-requirements. A1 says, using exhibit 1 only, make sure you fulfill the requirement. Whatever requirement is, you need to respond to requirement only. We're saying using exhibit 1 only. Here, you cannot refer to any other exhibits, okay? Discuss why Greenco should be classified as an associate and not a subsidiary. So what comes to your mind? Standards tested. Right, these are standards that come to your mind. Or any other standards? Anyone who is having any other standards in their mind when it comes to this one? Okay, so these are the three standards. What in particular? The question is, why an associate, not a subsidiary? You need to remember two terms: significant influence versus control. When you need to remember these two terms, you need to recall what gives you significant influence and what gives you control, right? So this question requires you to read the scenario, read the exhibit 1 and try to see whether is it significant influence that is right or is it control that is right? And by looking at it, you need to be able to justify. If significant influence, why? If control, why? Okay, that's the first question or first requirement. Requirement A2, using exhibit 1 only, explain. Now you see discuss, here it's explain how Greenco should be accounted for as an associate using the equity method. Equity method. Now you need to give an account of how you will be using equity method. And here you talk about equity method, what is it, how the calculation happens based on equity method, right? So you need to explain that. But before that, when you read the requirement or read the scenario, you need to try to figure out whether equity method was applied or whether was it not applied, right? So that's the question you need to answer. Was it applied in the the consolidated statement of financial position that they've prepared, or was it not considered, right? Right. B, using exhibit 2, explain briefly why the classification of Chuckleco's investment in Greenco should change on 1st of April 2086 to that of a subsidiary, right? Now remember, when you are reading the requirements, there are certain hints, right? There are certain hints that may help you with answering your previous questions. Now here they are saying, using exhibit 1 only, discuss why Greenco should be classified as an associate and not a subsidiary, right? So they want you to explain that whatever reason has not met for it to meet the control criteria, therefore significant influence, right? And then they are further solidifying, saying that it should be significant influence or associate, not a subsidiary. So you focus on bringing it as an associate, right? If you go to answer in A1 saying that, oh no, based on these justification, based on the standards, there is control obtained. Therefore, it should be accounted subsidiary. So there, you have not taken into account whatever the hints the examiner has given you. Okay, so make sure you work around the hints when you read the requirements. Then C, the requirement C has 3 sub-requirements. The first sub-requirement says, using exhibit 2, explain briefly how the additional purchase of the 18% equity in Greenco should be accounted for in the consolidated financial statement of Chuckleco, right? Explain briefly how the additional purchase. Here, explain briefly why the classification of Chuckleco's investment should change. Here, how the additional purchase to be accounted. So here you have to give the justification based on the standard theory or standard requirement of narrative. Here you need to also speak about how the calculation, you have to narrate how the calculation works. Okay, why and how. Using Exhibit 3, explain how the fair value of non-current assets and current assets of Greenco at 1st of April 2026 to be calculated. Now, fair value, when they talk about fair value, you can remember, you should be able to recall IFRS 13. But whether is it relevant to IFRS 13 or not, that you'll understand while you are reading the requirement. P3, using the pre-populated spreadsheet response option with Exhibit 3 and your previous answers, adjust the spreadsheet prepared by the directors of Chuckle in order to prepare a corrected consolidated statement of financial position. So they've also given you what are the areas spreadsheet should take into account, right? Accounting for the associate using the equity method, the change in classification from associate to subsidiary. So here you need to recall this theory. What happens when you step backward? Okay, when associate becomes subsidiary, you need to recall the theory, standard requirement here. The fair value adjustments on acquisition and goodwill using the proportionate share of net assets method. Proportionate share of net assets method. To calculate, now this would help you to evaluate what would be how you'll calculate your NCI, non-controlling interest. To calculate the non-controlling interest. Okay, proportionate share of net asset method. Right, so one is fair value, one is proportionate share of net assets. So you should be able to recall, okay, when you see the question, okay, this is how proportionate share of net asset method NCI should be calculated. You should be thinking about that in your mind. Okay, right, so it's a hint that you first need to correctly identify and account for the net asset method, and then or net assets, then you apply the NCI. That should be a hint. Now, when you talk about fair value adjustments, there is one more standard that you need to be able to recall. When there are fair value adjustments that take place, what other standard comes to your mind? Quickly tell me. How far-reaching you think the impact is? Again, you should be able to recall, compare, contrast with other standards. So tell me, particularly when you're talking about fair value adjustments, what other standard you think will be impacted? Anyone? Again, it's given in the question itself. Given in the question itself. You need to include the deferred tax adjustment. Recall the specific situations of deferred tax when it comes to consolidation. IFRS 3 anyway is relevant to this question, no, after because that we've already made a mark of, right? IFRS 3, 8, IS 28 going to be around for all the questions in this requirement. And then IFRS 13 is also going to be there. IS 12, income taxes, deferred taxation requirements. When it comes to consolidation, how deferred taxes work when fair value changes happen. So you should be able to recall that theory. Okay? Right. So that's the requirements. You saw how to read the requirements. When you read the requirements, you just don't read the requirements. You try to recall, okay, what goes behind the requirement. Okay, you try to identify the hints that the examiner has given you. All right. Okay, so now let's start looking at the exhibits. So deferred tax on goodwill is not going to be on goodwill, right? Deferred tax will be required to calculate goodwill. But what will deferred tax be used for? The net assets, yes, the fair value changes. That's what brings in the temporary differences, right? That's the reason for temporary differences. That's what will be looked at here. Okay? Right. Now let's read the exhibit. On 1st of April 2024, Chuckle Co. acquired 30% of the equity shares of Greenco. The consideration consisted of 100 million cash when you're reading, you need to be able to manage information, as we discussed in last class, right? 100 million cash. The carrying amount of the net assets of Greenco on 1st of April 2024 was 286 million, which was the same as the fair value. 286 million. But you need to remember, fair value adjustment is not factored here. Since then, Greenco has been stated at cost. Since then, Greenco has been stated at cost in the consolidated statement of financial position of Chuckleco. What should have been the case? It should have been using equity method, right? Subsequent measurement should have been using equity method. But here they are saying Greenco has been stated at cost itself, no any equity method used, meaning there's an error that needs to be corrected. Okay. In the consolidated financial statement of Chuckleco, the remaining 70% of the equity of Greenco at 1st of April was owned by a few other investors. None of which owned more than 10%. Right, now tell me, do you recall the conditions that are required for control? Now, control is not always 50% or above. It can be below 50%, but there should be other conditions that should be met. Just list down what you remember. List down. Shavi, are you there? Shavi, are you listening? What do you think, Shavi? You also can contribute. You also can list down. Yeah, this juncture, you all should be knowing the theory in and out, right? Right. So I'll just put the extract from the standard. Right. That is required for you to know. Okay. So I'll just put that on the chat box so that you all can try to recall. The requirement I have put on a chat box are the requirements that may mean that there is control even if the owning is below 50%. Okay. Investor has power over the investee. Investor is exposed or has rights to variable returns from its involvement. The investor has the ability to affect those returns, right, through its power over the investee, right? Those are the main criteria, and there are range of circumstances, right, that have been identified by IFRS 10, right? So whether the power exists, whether the control exists, an organization is able to control or not, is dependent on certain criteria. First, exercise of the majority of voting rights. right? Are there more voting rights that they have that they can exercise? Contractual arrangements between the investor and other parties, right? If there's a contract that gives one company the ownership or the control, right? Holding less than 50% of the voting shares with all other equity interests held by numerically large, dispersed, and unconnected group, right? And holding potential voting rights, such as convertible loans that are currently capable of being exercised, right? And the nature of the investor's relationship with other parties that may enable that investor to exercise control over an investee. Okay, so those are the criteria that you need to look at to decide whether or not the control exists. Now, here this says none of which owned more than 10%, few other investors. There is a requirement that says, right, when the holding is less than 50% and all the other equity interests are held by numerically large, dispersed, unconnected group, right? It's all less than 10%, but it's few other investors, right? So is it numerical? Is it, dispersed? Is it unconnected, numerous people? That's a question that you need to think through when you are responding, okay? Analysis shows that all coming back to the question. Analysis shows that all shareholders have voted independently in the past. There has been no clear past voting pattern suggesting that Chuckleco is unable to directly influence the economic decisions of other investors. There is no idea about voting rights, right? So there is a requirement that says exercise of the majority of voting rights in an investee that may give you power. But there is no evidence for that, right? Whether you can directly influence or not, that is based on the voting patterns, but there is no clear past voting patterns, right? You have to use all those information to prove whether is it control that's correct or significant influence that's correct, right? The first requirement. Then Chuckleco and Greenco share some key management personnel. Some key management personnel. This is some important information, right? No clear past voting pattern. Right. The carrying amount of net assets of Greenco was 348 million on 31st of March 2026. The increase in net assets of Greenco since acquisition was solely due to profits. 348 was solely due to profits. Now, why is that necessary? Why? Understand what should have been the recognized investment based on equity method. Why? Because they have considered it under cost method, right? That's why you need to have an understanding about the 348 million, which is the carrying amount. Okay, and what's the profit component there? All right. 30%, 286, 348. The difference is going to be a post-acquisition profits, right? This exhibit you have to use respond question or question A, requirement 1 and 2. Right, let's go back to the requirements. So it says using exhibit 1 only, A1 and A2. Ask you to use exhibit 1 only, right? And how Greenco should be accounted for as an associate, you need to use that, and you have to correct that at the end also. Pre-populated spreadsheet. Why that error needs to be corrected. All right. Okay. Then exhibit 2. Chuckleco acquired. Now you'll understand why it should be a significant influence and not control, right? So when you're responding to the requirement 1, you first give a short definition about significant influence, right? So what is significant influence, right? The ability to participate in the financial and operating policy decisions of the investee, right? But should not be able to control, or there should not be joint control, right? So controls an investee only if the 3 criteria are met as per IFRS 10, right? The power, the exposure, the ability to use its power, right? You have to mention those. And then you can say control is presumed to exist where the investor has a majority of the voting rights. Then whatever the points they have mentioned in a scenario, they spoke about voting rights, they spoke about number of shareholders, right? So So use those two and bring in the IFRS 10 points that is relevant to those two, and try to prove, telling that because of this is not met, because this is not met, it does not meet the criteria, right? So that's how you would be structuring your answer. Okay, that's how you're going to structure your answer. Okay, you have to incorporate all those points. Now we'll be going into the requirement number or exhibit 2. Okay, but remember, when you are bringing any theory in your question, don't just bring theory as it is. Try to connect it to or apply to the scenario, right? That's why I told you, if they've given the voting rights and those two details in the scenario, use those two only, right? Don't try to bring in all the theory, because if you bring all the theory, it's not going to gain you marks, right? But connect with a scenario, right? So you can tell voting rights, but based on this company or Chuckle Co does not have the voting rights. There's no clear patterns of voting rights with Green Co. So connect it to the scenario, right? So what you'll be doing here, you'll be discussing what control is, what significant influence is, and you'll be connecting it with the scenario, and you'll be giving your opinion. Why significant influence and why not control? Okay, right. Then the second requirement also wants you to look at only exhibit 1. Explain how Greenco should be accounted for as an associate using the equity method. So here what you have to do is you have to give a short explanation about what equity accounting is and how equity accounting is done, right? Then you have to calculate the investment in associate, right? You'll be getting marks here. So that's why, there is calculation, there is numbers, but not too much. Even numbers that you bring in should be in a narrative style. Okay. So for example, you can say Greenco was measured, or Greenco was recognized, the fair value was recognized at cost, and there was no any subsequent measurement changes that happened using equity method, because an equity method is the method. You explain what the equity method is, you give that small definition from the theory or the standard, and you go on to tell that in equity method the subsequent measurement is going to be take into consideration the percentage, the parent percentage of post-acquisition profits of the associate, right? So 100 million was already recorded. So the difference, the valuation was 118.6 million. So the difference 118 for 100 million plus 30% of 348 minus 286, right? So that is what brings it to 118.6 million. Okay, that's how the calculation comes in. And this should be, now here you have to talk about the impact, right? The profit impact, where is it going to be, right? Is it going to just impact the equity method calculation under your assets, where you measure your investment in associate, or is there another component that's being affected? There is another component, right? If it's profits, it's going to impact your retained earnings, parents' retained earnings. So for this, you need to be thorough with the standard. You need to be thorough with these chapters of consolidation, and you need to know how the workings work as well, right? It's a presumed knowledge from FR, but there's a in-depth knowledge you would have gained in SBR about how an equity method is going to impact the asset as well as your retained earnings. Okay, so in this requirement, you'll be giving a short definition of what equity method is. You connect it to a scenario like how it was measured at cost and not using equity method, which is an error. So if there's an error, what happens? What's the standard that applies here? There was one more standard that applies here. IAS 8, right? There's an error. So when there's an error, what you need to do? You do a retrospective adjustment, right? You have to go and make the retrospective adjustment, right? So when there's a retrospective adjustment, you have to rectify the retained earnings as well, right? Which is why the retained earning component is going to be affected. Okay. Right. That's how you answer your requirement or A2. Now B. This you have read exhibit number 2. Exhibit 2. Chapelco acquired a further 18%, 30 plus 18, 48% of Greenco's equity on 1st of April 2026. The remaining 52% of the equity of Greenco at 1st April is owned by a few other investors, none of which own more than 10%. Again, it's not numerous, it's just few. Okay. Chapelco also acquired some share options in Greenco exercisable anytime until 31st of March 2027. Now you have to look at the share option. Is there potential share options which they can convert, right, in the future and own more of it, right? But you will be able to convert it only if it is beneficial, right? The exercise price of the options at 1st of April 2026 was just above the market price of Greenco's shares. Exercise price above the share price. So do you think it's beneficial? Will Greenco convert it because it's above the share price? No. It should be below share price in order for it to be in money or to be beneficial, right? But it's above the share price. So it's not beneficial. But let's read further. It says Greenco has been profitable for a number of years and the share price has been on an upwards trend, which is expected to continue, meaning share price is going to go up, right? And Chapelco would increase its ownership to 60% should it exercise its right. It is believed that there would be additional cost savings should the additional shares be acquired as decisions at board level could be made more efficiently. Now, what this entire exhibit says is that conversion of the convertible shares, the options that they have, share options, is beneficial. Why? The share price is expected to go up, right? Though for the moment it's below, it's expected to go up, right? And converting is also going to give an additional benefit to Chapelco where they can make decisions easily, right, at the board level. There is a benefit that Chapelco will have if they convert the shares, even if the share price does not go up. So considering that, you can see that it is going to be beneficial to convert the option, and you'll be becoming 60% shareholder. Now you become majority shareholder. Therefore, now you have obtained control. Though not directly, still you have not converted, so you don't know, but you hold, Chapelco holds convertible share options, which is beneficial to be converted. Therefore, there is control obtained now. That's how you respond to the requirement B. Okay, that's how you're going to respond to requirement B. Again, when you are answering, it needs to be in full sentences, not bullet points. Okay, be careful about that. It should be in a report structure. All right. Okay. So that's requirement B. C1 says, using exhibit 2, explain briefly how the additional purchase of the 18% equity in Greenco should be accounted. Again, a calculation aspect. Right now, here there's calculation aspect. So here you have to prove that control has been obtained to, right, with facts in the scenario, right? And here you again, calculation is required here. You have to be able to give calculation, but before you give calculation, right now here what they're saying, how 18%, how the additional purchase of 18% equity in Greenco should be accounted. So you have to talk about goodwill. Talk about goodwill, you have to talk about fair value changes of net assets, right? So fair value measurement plays an important role here, right? So this one, exhibit 2, you have to explain, but here they have not limited it to exhibit 2 only, right? So you need to make sure when you are talking about the calculation aspect, right, goodwill aspect, you need to have the details about net assets, right, in which is given in exhibit 1, right? You need to know what was the value before and what was the fair value in order to identify how step acquisition works. Now here you need to be able to recall the theory of step acquisition, right? When associate becomes a subsidiary, right? You have to first revalue to its fair value, then you take the gain or loss, and then it's a new fair value based on which you'll be doing the goodwill calculation. So new fair value would be the existing control, and then you will be adding the new consideration to obtain 18% rights, and then you'll be doing the rest of the calculations. Okay. And to do goodwill calculation, you also will need to look at the net assets value, and therefore you will have to read further exhibits to understand what are the other information that's given. Okay. So C2 says, using exhibit 3, explain how the fair value of non-current and current assets of Greenco at 1st April should be calculated. Right. Okay. So C2 requires you to do that, the fair value. Here they require you to briefly explain how the additional purchase of the 18% equity should be accounted for. So here you talk about, let's say, step acquisition, how step acquisition is accounted. You bring in the standard requirements, right? How the fair value for the existing, existing investment, you have to kind of revalue that to fair value. Then you have to bring in the new consideration that you've paid. Then you have to calculate all the net assets to its fair value, right? Then you have to check the deferred tax component to the fair value. Then you have to calculate an NCI based on the fair net assets of fair value. Then you'll be arriving at goodwill. So give a brief understanding about how the concept work. Though you're not going to use clearly all the numbers here because C2 requires you to do that. Here you'd be just giving a brief understanding, right? How it's a step acquisition or piecemeal acquisition, how the rest of the requirement of goodwill and all the requirements of subsidiary would be arising, right? Explain that in C1. But when it comes to C2, for C2, you have to use the exhibit 3 to explain how the fair value of non-current assets and current assets of Greenco would be calculated. Okay, now let's read exhibit 3 for that. Exhibit 3. The directors of Chuckle Co. have prepared a spreadsheet of the consolidated statement of financial position. Right? Give me a moment. Right. The directors of Chuckle Co. have prepared a spreadsheet of the consolidated statement of financial position as at 1st of April 2026 in Exhibit 4. The investments in Greenco have been stated at cost 100 million and 66 million. And the net assets of Greenco have been included at their carrying amounts. The equity of Greenco has also been included as a balancing figure. Goodwill has not been calculated. The consideration for the further 18% of the equity shares of Greenco on 1st of April is included in statement of financial position at the cash amount of 66 million. The fair value of the original 30% equity interest was 127 million. This is important. The carrying amounts of the net assets of the Greenco were as follows. Non-current assets 355, current assets 214, deferred tax liability 16, current liabilities 205. That's the total 348. Okay. Included within the non-current assets is some land. The carrying amount of this land at 1st of April 2026 is $50 million, but its fair value is assessed to be $60 million. There's a fair value increase, right? Land is not depreciable, right? So there is no excess depreciation here, right? But when there's a fair value increase, there is going to be temporary differences that's going to arise. As a result, deferred tax. Okay, so there is a deferred tax liability on this. Current assets include finished goods with a cost of 84 million. Now here comes the inventory, right? The fair value of these goods is 131 million. On 1st of April, the director of Chuckle Co. also identified that Greenco had an internally generated database of customers who were likely to be interested in purchasing their products. Okay, there is fair value of goods, that's 131 million. But if you take IAS2, that's not going to work here. You have to use IFRS 3 requirement here. What does IFRS 3 say? What does IFRS 3 say? That's by IFRS 3. Break it. At acquisition, the fair value of finished goods inventory is generally measured as estimated selling price of the inventory, less the sum of cost of disposal and a reasonable profit allowance for the selling effort. So what you need to take here? The fair value 131 million. So when 84 becomes 131, there is going to be a deferred tax impact here also, right? On 1st of April, there is database, right? Now, when there is an internally generated database of customers, when it's internally generated, intangible asset, you cannot recognize it. IAS 38, right? IAS 38 requirement says you cannot measure, you cannot recognize an internally generated database. But when it comes to acquisition, you are purchasing. Now it becomes a purchased intangible asset. So now you need to recognize that, right? Who are likely to be interested in purchasing their products, although there were no contractual or legal rights associated with this database. A professional expert has estimated that competitors of Greenco would be prepared to pay 5 million. Cost can be reliably estimated. That's the criteria to record internally generated intangible assets that are acquired, right? Greenco has not recognized the database as an asset within the individual financial statement. The current rate of tax is 20%, right? And they are saying that there are competitors that are willing to pay also, right? Meaning there is economic commercial feasibility of it as well, right? This rate should be applied to any fair value adjustments deemed necessary. Why are they giving tax rate? So that you know, okay, at what rate will you be doing the deferred tax adjustment? Right? At what rate are you going to do deferred tax adjustments? Okay. So far, does that make sense? Is that clear so far? Right, perfect. So what will happen now? You have to take the fair value increase. 50 becomes 60, there is 10. 84 becomes 131, the difference there. Then you have 5 that's unrecorded becomes 5. So you have to take 20% of each of these. You take 20% of each of these and you have to deduct that as a deferred tax component against each of the revaluation, right? So you can either deduct it while you're going, or you can take all the fair value increases and you can deduct the deferred tax impact to these fair values all at once when you're calculating goodwill. Okay, right. So that is that you need to use to explain. So you will be explaining 550 becomes 60, what's the deferred tax impact there, to bring in some IAS 16 there. Then you have the second, we've already discussed that, right? So second, which is goods or finished goods. So you bring in that theory part, right? You have to measure it at this value. Therefore, you have to recognize that 131. Then internally generated database, you give that explanation. If it's internally generated, it's not recorded in their financial statements. But now, since you're acquiring, you'll be recognizing because the cost can be reliably estimated, as well as there is a commercial feasibility, meaning competitors are willing to buy it, right? There is a market for it, right? So based on that, you'll be giving the IFRS 13 references as well. Okay, the fair value references. So that's requirement C2. Then comes the final requirement, C3. Using the pre-populated spreadsheet response option with Exhibit 3 and your previous answers, adjust the spreadsheet prepared by the directors of Chuckle Co. in order to prepare a corrected consolidated statement of financial position. Okay, now you need to take into consideration the spreadsheet adjustment. All right, let's go into the spreadsheet and we'll see how the calculation impacts those spreadsheets as well. All right. right? So now you all will have to confirm that you can see the Excel. Can you see the Excel? All right, thanks for confirming. Right. So what are we supposed to do here? We're supposed to take all the calculation that we read through into consideration and make all the adjustments, right? So what are the adjustments that we are expecting, to impact this financial statement? Because this is an incorrect statement, there are certain adjustments you have to do here. Okay, the adjustments we'll be doing is going to be investment in associate equity method, right? That's one. And then you'd be doing the adjustments for, once it becomes a subsidiary adjustments. So step acquisition, right? Step acquisition, fair value measurement, fair value of net assets, deferred tax, right? Deferred tax, goodwill, right? And then any impact there has been for retained earnings, right? And non-controlling interest, right? This is what the requirement says. Account for the associate using equity method. The change in the classification from associate to subsidiary, step acquisition. Fair value adjustment on acquisition, proportionate share of net assets method. Okay, so those are the adjustments that we are expecting. Okay, right. So when it comes to equity method, right? When it comes to equity method, what do you see here? You go here, investment in associates 100 million, right? Let me bring the question here also, the exhibits, so that it's easier for us to go back and otherwise we'll have to go back and forth to the with the documents. So you have 100 million, carrying amount of net assets 286 million, but as at March 348 million, which was solely due to profits, right? So what do you do here? You have to first go and do the working to adjust what the difference has been, right? Whatever difference that has been. Okay, so how do you know the share of post acquisition? So it's equals 348 minus 286, but not that into 30%, 18.6, right? It's supposed to be 118.6. Okay, let's take these as a separate sheet. It's disturbing our proceedings. Right. So let's take exhibits and separate it. That's easier. First adjustment, how you are going to use this sheet is you'll be, whatever adjustment you're making, you'll be putting that as a title first. Equity method correction. Okay. Correction in equity method. So here you have to add 18.6. The investment associate is going to be shown as 18.6. But that's not it. there is going to be an impact on retained earnings also. Your retained earnings also need to increase by the same amount. Okay, that's the equity method correction. Then what happens after equity method correction? What happens? Subsidiary adjustment. Now it becomes a subsidiary. What has happened here? Further investment associate has been recorded as further investment. So you have to remove that, right? So you have to remove that entirely. Why? That is completely wrong. Incorrect require or incorrect thing that they've done, right? So here you have to remove the equity and cost of associate since it becomes a subsidiary, right? That's in brackets. You all don't need to type this entire thing. You just have to type remove the equity and cost of associate, right? So you have to remove this minus 66. Use plus and minus signs. And what's the cost you have to remove? Right, this is the cost with investment associate, and then this is the equity you have to remove. Right, you have to remove the equity 348. Okay, right. So why you did that adjustment? Because now it is becoming a subsidiary. So you need to de-recognize the associate and you have to recognize it as a subsidiary. Okay. So before de-recognizing, what you have to do? There's a working space. Let's use its working space to do our first working investment in associate, right? So the cost was 100. The share of post acquisition retained earnings or equity which was, as we calculated, 18.6, right? Yeah, take both of those into consideration, and that would give you the value of your investment associate as 118.6 when you are making the piecemeal acquisition, right? Now you need this number in order to calculate what was the profit that you gained from this, right? Now there was an exhibit that spoke about the fair value, right? The fair value. The exhibit 3 spoke about the fair value of equity interest as well. Let me bring that information here. Right. So it told that the fair value of the original 30% equity interest was 127 million at that date when they were making the piecemeal acquisition. It became 127 million, right? Fair value of associate. So what does the standard say? First, you have to value it to fair value, right? April X6 127, and whatever the gain is, you have to take to SOPL. What's again? This minus this 8.4 million is the gain. So what you'll be doing here, when you're removing the investment in associate, now you have to remove the investment in associate. Remove investment in associate, right? So here you have to remove the incorrect one that you had. Now here you have to remove the actual associate. You have to de-recognize the associate. So you are going to remove 100 and this plus this 118.6, right? Minus, right? There you use the minus figure. And then there is 8.4 million gain that you will have to record in your retained earnings. Your profit increases. So that's 8.4 that we did in the working. Okay. This is a working where we got this answer. All right, so that's removal of investment done. Okay. Now what's the other thing that we have to do, right? Or rather, not investment. Here we'll name it as gain on disposal of associate, right? Rather than removal, let's say disposal. Assortment, right? If it's a removal, again, it's the same thing, but to make it more clearer, you can use the term disposal of associate, because you dispose associate, then you go into the piecemeal acquisition for it to be converted into a subsidiary, right? So you can also call it acquisition. You can give this reference in brackets, but not necessary. Okay, right. Then you have to look at the fair value changes. The fair value changes happened at 3 instances, right? There were 3 assets that saw the fair value change, right? So let me bring that exhibit now. Right. That's the exhibit. So what does it say? There's a fair value of land. There's a fair value for goods, which is current assets, non-current asset, current assets, and then intangible assets. Right? There are 3 fair value uplifts that we are looking at. Okay, right. You go here. Now you can put the topic as land fair value. Then you can put as inventory fair value. Then you can have database fair value. Right? These are 3 fair value adjustments that you're going to do. When you're doing fair value adjustment, you have to take deferred tax component into consideration as well. Okay. Land increased by 10, right? 50 became 60. So what should increase? Your property, plant, and equipment needs to increase. But there is a liability that's increasing also. There's a deferred tax impact, right? Where is the deferred tax impact? Non-current liability, deferred income tax liabilities. So you go here and you calculate 20% of your $10, right? So that's 2 million. Inventory, it's the current asset, right? This is where you make the inventory adjustment. What was the inventory uplift that we saw? Right, let's go back to the exhibit. It says 84 becomes 131 million, equals 131 minus 84. 47 million is the uplift. Again, there is deferred tax impact, equals this uplift into 20%. That's 9.4. Okay. Then there's database. Database is going to be recorded as intangible asset. Do we have an option here, intangible asset? No, but we have other non-current assets. That's where we are going to record the database. 5 million. There is a deferred tax liability. 5 into. Remember, any fair value adjustment will have a deferred tax implication. Any fair value uplift will have deferred tax implication because of temporary differences arising. Okay, right. And then now we can go for goodwill, right? Goodwill and NCI. Okay, so this will do another working, right? We'll do another working here. Goodwill at acquisition. This will go as working 1. Okay, so calculating goodwill, fair value of original investment. or shares. We saw that equals 127. That's the fair value, right? Then fair value, new investment or new shares. What's the fair value? We saw we removed it from here, right? 66. 66 was the new investment. Okay. Exhibit also. There's an exhibit that gives that information. Let's go and check that exhibit out. Let me bring that exhibit here. Here we go. Exhibit 3. And that phone call ringing. I don't want to answer that right now. It's a little far from me for me to go and put it on silent mode. Right. So in this, you see, they are saying there is 66 million. Okay, there is 66 million. That's what you'll be considering for your new shares, which is 66 million. All right. That's your fair value of your new shares. Now, what you have to do is you need to take your fair value of your net assets, right? What was the fair value that we saw? Fair value of net assets at acquisition. It was 348 million, right? That's what we removed from here. When we removed 66, we removed 348 also. Why? We were calculating it in goodwill, right? That was 348 million. And then you have to take all the fair value uplift. Land fair value, inventory fair value, database fair value, right? So land fair value went up by 10, inventory fair value went up by, let's give the reference so it's easier. Right? Went up by 47. Database went up by 5. And deferred tax. What was the deferred tax of all of this? You can sum these three and you can put 0.2. So this you have to deduct. Right? This you have to deduct in order to arrive at your fair value. Right? So what is the amount? It's 397.6. Right? 397.6. So let's take both of these. Let's keep a space for NCI here. Okay. Right. So total consideration was 193, right? And apart from that, there's an NCI. How much? 48% we own. NCI is going to be therefore 52%, right? And this is sum of, again, you have to minus this, right? Now you have 397. You need to take 52% of 397 equals sum into 0.5. So that is your NCI. Right? So what's the total investment? Total consideration is 399. Then you have the fair value of net assets of 397.6. So what is going to be your goodwill? Goodwill at 1st of April X6 is going to be this minus 397. So when you have already put the minus there, you'll be doing it as a plus, right? 2.15 further 2.2. Right? That's the closer decimal. That's 2.2. That's your goodwill. Okay, how are you going to record that? You're going all the way up. There is a goodwill option. You will be bringing the goodwill here. And then there is a non-controlling interest option under your equity. Non-controlling interest is going to be, it's the one. There you go. And remember, in the exam, you're not supposed to put a total column. Total column is just going to waste time, not going to give you any marks, right? But just for the purpose of calculation right now, since it's not exam setup, I'll be using total column. But do not use total column. Do not waste your time in putting a total column and putting, trying to total it up, right? Just leave it as it is. We pull all the way down. Here, then this will be the sum of this, right? Current asset is again, copy this and paste it here. The total assets are going to be sum of these two, 2813. Okay. Then you have equity. Again, you'll be taking the sum of both columns. Only total columns you will have to bring the adjusted total. Therefore, you have to bring the adjusted total, right? Again, you go here and you sum all of those. Now you would have your adjusted total for your liabilities and equity as well. 5. Right, 533. And then current liabilities of 576. Right, again, paste it here, and you'll have your total liabilities. We don't do the calculation here. We'll go here and do the total liabilities calculation, sum of current and non-current, right? That's 902. And now you'll be not sum, rather this plus your total equity. There we have. This is the total equity and your total liability. There you go. Still, there is something wrong with calculation. This plus this plus this. Now I think it will be okay. Yeah, we missed to take non-controlling interest. All right, so there are two equity components, total equity and non-controlling interest equity. Then you have total liability, so 2813. 2813, it balances. If you done these adjustments right, it is anyway going to balance. Does it make sense how to use this, the structure, the pre-populated worksheet or pre-populated spreadsheet? Or do you still find it complicated and difficult? What do you think about a pre-populated spreadsheet? Is it complicated or difficult? Or is it all right? Perfect. Right, so clear how this question works. because I'm having a plan to do one more question one with you all, so that you all will be very much comfortable with question one, which would be next week, specimen two. I'm trying to do that, and then pre-mock. So we'll be able to do more questions on that. So we have three more sessions, right? We have on 16th, 23rd, and 30th. So next week, we'll try to do specimen 2, question 1. 23rd, we'll try to do either pre-mock or the question 2, 3, 4 of one of the papers. We won't be able to do all the questions of both the papers. So today we did question 1 of specimen 1. Next week we'll be doing question 1 of specimen 2. On 23rd, we'll be doing question 2, 3, 4 of either specimen 1 or specimen 2. We'll try to do all 3 questions on 23rd. And then 30th, we'll discuss the pre-mock. So by that time, I expect you all to finish the pre-mock as well. So once you finish, then we discuss would make more sense. So by 30th, we'll discuss the pre-mock, and with that, we'll be able to go and be happy, SBR candidates going and doing the exam and taking flying colors or passing with flying colors. All right. So that was it for today. I was planning to do question 2, but we were not able to. We did not have sufficient time to do that. But let's do it on not the next week, the week after, right? But before we conclude, I'll just try to give you all a guidance how, when you all are reading an ethics question, how you all will be doing the reading. Okay, so I'll just go back to the Word file with a question. All right. Okay, so here the exhibits, let's just quickly talk about exhibits, how to identify what the standards are. There's related party transactions. So here you need to recall the theory of IAS 24 standard. Subsidiary fair value adjustments, IFRS 3, IFRS 13, IFRS 10. Goodwill impairment calculation, IAS 36, right? And IFRS 3. Right. Then as we read through, we see that there are multiple standards that are being tested here. So let me just quickly run through certain segments of this question. Right. They're speaking about loss allowance, right, on a trade receivables, right? Loss allowance on trade receivables. So that is testing. You need to recall the ECL model of IFRS 9, right? Then we go down further. Fair value adjustments is IFRS 13. Impairment is IAS 36. And then you have to talk about the ethical and safeguards. You need to keep this in mind as well. Okay. So reading through, you need to capture the standards and you need to respond to these ethical questions by aligning yourselves or aligning your answers with the standard requirements and giving an answer that is ethically and morally right. And that should show you as a professional accountant, or your mindset should be visible to the examiner or the paper marker as the one of a professional accountant, right? As if a professional accountant has written down the answer by referring to the standards, by referring to the ethical threats or ethical dilemmas, and how those conflicts of interest come into place, and or bringing all that together would prove you to be a good professional accountant from the perspective of the examiner, and you'll be receiving the 2 professional marks there. All right. So that's question 2 in a summary, but we will be going through question 2, 3, 4 in detail on not the next week, but the week after. Before we wind up, any questions? Before we conclude for the day, any questions? Or are we good with what we discussed today? So far, what we've discussed in that, you all need to remember the fair value and deferred tax, how you bring the contrast between those standards. So if you are not very familiar with, try to familiarize yourself as to how fair value uplift impacts or brings in temporary differences, and how that's going to impact on your deferred tax. Just try to do that as a mind clearing mechanism, where you'll be able to bring in the contrast, and you'll be able to identify the standards that are connected to each other. All right. Okay. Since there are no questions, we are good to conclude for the day. I'll see you all again on next Friday. Until then, all the very best with the preparation. Keep practicing as many questions as possible. Look at all the standards. Be thorough with all the standards, especially standards that we discussed today. So I'll see you all on next Friday. Until then, stay safe, take care, have a great week ahead.